Good day, and now let's proceed to the changes in accounting estimates and policies and corrections of error, which is the IAS 8, wherein it is applied in selecting and applying accounting policies, accounting for changes in estimates, and reflecting corrections of prior period errors. The standard requires compliance with any specific IFRS applying to a transaction, event, or condition, and provides guidance on developing accounting policies for other items that result in relevant and reliable information. Changes in accounting policies and corrections of errors are generally respective application means adjusting the opening balance of each affected components of equity for an earliest prior period presented and the other cooperative amounts disclosed for each period presented as if the new accounting policies had always been applied. Let's move on with the objective and scope. Accounting policies are specific principles, basis, convention, rules, and practices applied by an entity in preparing and presenting financial statements. A change in accounting estimate is an adjustment of the carrying amount of an asset or liability or a related expense resulting from reassessing the expected future benefits and obligation associated with the asset or liability. And then IFRS or International Financial Reporting Standards are standards and interpretation adopted by the IASB, which is the International Accounting Standards Board, comprised with the IFRS, IAS, IFRIC. Let's proceed with the materiality. Why did we mean by materiality? Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence these decisions that the primary users of the general purpose financial statements make on the basis of the financial statements, which provides financial information about a specific entity. Well, let's move on with the prior period errors. What do we mean by that? These are omission from or misstated in an entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information that was available and could reasonably be expected to have been obtained and taken into account preparing those statements. Such errors result from mathematical mistakes, mistakes in applying accounting policies, oversights, or misinterpretation of facts and fraud. Changes in accounting policies. What do we mean by that? Or let's explain it. An entity is permitted to change an accounting policy only if the change is required by a standard or interpretation or results in the financial statements providing reliable and more relevant information about the effects of transactions, other events, or conditions on the entity's financial position, financial performance, or cash flow, or IAS 8.14. The effect of a change in an accounting estimate shall be recognized prospectively, like what we said a while ago, by including it in profit or loss, the period of the change if the change affects the year only, if the prior of the change if the change affects that period only, or the period of the change and future periods if the change affects both. Well, let's move on with the errors. The general principle in IAS 8 is that an entity must correct all materials prior period errors retrospectively in the first set of financial statements authorized for issue after their discovery, restating the comparative amounts for the prior periods presenting in which the error occurred if the error occurred before the earliest prior presented, restating the opening balances of the assets, liabilities, and equity for the earliest prior period presented.